What's going on, everybody? This is Coach Wade, and today I want to answer a question that a lot of investors eventually ask. Should you own international index funds? Now, if you've been following this investing series, we've already talked about the S&P 500 index fund, and we've talked about the total stock market index fund. Both of those focus primarily on companies in the United States. But what about the rest of the world? Should your investment portfolio include companies outside the US? Let's talk about it. First, what is an international index fund? An international index fund is an investment fund that tracks a broad group of publicly traded companies located outside the United States. Instead of investing only in American companies, these funds invest in companies from countries around the world. That can include companies based in places like Japan, Canada, the United Kingdom, Germany, France, Australia, South Korea, and many other developed and emerging markets. In other words, instead of owning businesses from just one country, you're gaining exposure to companies from many different parts of the world. Now, let me ask you a question. Do you think great companies only exist in the United States? Of course not. There are successful businesses all over the world. Some manufacture and art automobiles. Some produce technology. Some develop medicines. Some operate banks. And some build infrastructure. And some provide products and services that millions of people use every day. International index funds give investors the opportunity to participate in the performance of many of those companies through one diversified investment. Now, here's another question. Why would someone want to invest internationally if they already own U.S. stocks? The answer is diversification. You've probably heard me say this before. One of the basic ideas behind investing is not putting all your eggs in one basket. Diversification isn't about trying to predict which country will perform the best next year. It's about spreading your investments across different markets and economies. Think about it this way. Imagine you own rental properties. Would you rather own every property on one street? Or would you rather own properties in several different neighborhoods? Many people would prefer spreading their investment around. Why? Because different areas may perform differently over time. The same idea applies to investing. Different countries, different economies, and different markets don't always move in exactly the same direction at the same time. Now, I also want to point out something important. International investing comes with additional risk. Different countries have different economies, different political systems, different regulations, different currencies, and different market conditions. All of those factors can affect investment performance. For example, changes in currency exchange rates can impact returns. Economic slowdowns in one country can affect businesses there. Political events can create uncertainty. That's one reason international investments may perform differently than U.S. investments over certain periods. Now, here's another question I hear all the time. Coach Wade, should I invest only in the U.S. companies? Or should I own international investments too? The answer depends on your personal financial goals, your investment strategy, your risk tolerance, and your overall asset allocation. There isn't one answer that's right for everyone. Some investors choose to invest only in U.S. companies. Others choose to include international investments as part of a diversified portfolio. Both approaches exist. The important thing is understanding why you're making the decision, not simply following what someone else is doing. As I teach in stage 4 of the 7 stages to financial independence, the wealth building zone, investing should be intentional. You should understand what you own, why you own it, and how it fits into your long-term financial plan. Another thing I like about international index funds is that they're designed to keep investing simple. Instead of trying to research hundreds of companies located all over the world, an international index fund provides broad exposure through a single investment. You're not trying to guess which company in another country might become the next success story. You're simply investing in a broad collection of businesses. Now remember, just like every other stock investment, international index funds can go up, they can go down. There will be good years and there'll be challenging years. Investing always involves risk. Past performance doesn't guarantee future results. That's why successful long-term investors usually focus less on what happened this month and more on where they're trying to be decades from now. Here's what I want you to remember. International index funds allows investors to own shares in companies located outside the United States. They can provide additional diversification by expanding your investments beyond one country's stock market. Whether international investing belongs in your portfolio depends on your personal financial situation and your long-term investment strategy. The important thing isn't trying to own everything. The important thing is having a thoughtful plan, staying diversified, and remaining consistent over time. I'm Coach Wade, and I believe successful investing isn't about chasing what's popular. It's about understanding what you own, building a plan you can stick with, and allowing time to work in your favor. Because wealth isn't built by reacting to every headline, it's built by making informed decisions, remaining disciplined, and investing consistently for the long term. I'll see you in the next lesson.